Broadcast. Welcome to the Zaner MarketCast, your one and only spot to keep up with all of the agricultural market news. I'm Joe Nikruto, here with me today, as always,
Dan Hussey.
Dan
How's everybody
Hussey.
doing today?
Today, we're not going to cover in great detail. We're going to take a swipe at the stocks report numbers here for Tuesday. We are going to take a look at where the markets ended up. Basically, what we want to alert people, Dan and you and I were talking about this, the best bet for folks to get up to speed on this, Dan, what would we recommend?
I mean, one of two ways, right? You can sign up for that Zaner Ag Hedge MarketCast with Ted daily for that call-in. Or secondly, sign up to get Karen Braun's newsletter, where all of this information is covered daily in her outlooks on some of these numbers. And not just outlooks, right? Where some of the data, right, compiled over the last 10 years here. I'm looking at a chart of hers for the last 20 years worth of data on and the difference of soybean between the August and June reports. Like, those are important things to consider. And one of the best ways to get them is signing up in those links below.
More information is better than less information under these circumstances, and the information that Karen and Ted provide, the information that Zaner Ag Hedge provides, in our opinion, unparalleled. It's an easy grab. Those links are down below. You can sign up. There's no risk. There's no obligation. There's no cost. We might phone you and say hello and find out if there's anything else we can do to help you in terms of market action or risk management. But other than that, very comfortable way to get access to such a high level of analysis, wouldn't you say?
Absolutely it is. And so do check out those links in the comment section and information section of this. And Joe, I think without further ado, let's just dive right into it. Today we had our quarterly grain stock estimates. One of the big surprise of the talk that actually had like our internal group kind of scratching our heads a little because of how big of a change that number was that corn number coming in well above analyst expectations. So it wasn't as much, right, that it's a difference between like June to now or August till now. It's that analysts missed this corn number in such a big way. Corn ending stocks coming in at 1.532 billion bushels. That is almost 200 million bushels more than the pre-report trade average guesses of 1.37 billion bushels. USDA ending stocks for September came in at 1.325. And that was, of course, 24-25 ending stocks. And then September 24 stocks from last year were at 1.763. So, right, we're smaller than last year. Analysts were looking for a much tighter grain stock. We found 300 million bushels in this USDA number. And I think corn reaction was probably somewhat tempered to exactly that today. Do we want to go into soy, or should we go over some corn numbers?
Some technical damage, right? You've been treading water here for a couple of weeks, as we have been talking about for the last couple market casts. You opened today at 421.25 after yesterday's price action was best described as pre-report.
Yeah.
Friday, a little bit of weakness in terms of position squaring. Today's open 421.25, high 421.5, low post report 414, and closed at 415.5, down 6 on the day. And I would say some technical damage there, right?
I mean,
maybe not so much damage. It's just falling off of that 100-day yet again. Was that 100-day or 50-day? That's 100-day, that 424.5, and now making our way down to the 50-day at 414, held the low from what I believe was September 2nd, which was 414. What did we say today's low was? 414. I don't know, Dan, technical damage, or how would you characterize that?
Yeah, I mean, it is slight technical damage, but I don't think like one day down a trend reversal makes here. Let's see if there's follow through, right, from a number like today. Don't get me wrong. It was a bearish report against trade expectations. The market traded lower. Everything kind of went exactly how you'd expect it to go. Down 6 cents for corn is not earth shattering. It's a decent move, but we certainly haven't, I think, put enough damage on the chart to say, oh, we're going to be really taking out $4 at this point, although that would be the next logical major supportive level to the downside. There's still, I think, the ability for this market to find some support and trade right back up in this range that we've been in. You get through the highs of this month and we've got a different technical ballgame. But for the time being, we have a report. It was more bearish against trade expectations. Those extra bushels have to be accounted for in that extra supply. And if that 6 cents is all it took, maybe that was all it took.
And so had we closed better, that 4.7, 4.15, what did we say it was? 4.15 and a half.
Yeah.
Had we closed higher within the day's range, you could make an argument for lack of confidence in these numbers and the market kind of shrugging it off and going back to talking about disease and the potential for reduced yield in the here and now. But you got to wonder, this brush stroke on the chart sort of, folks are maybe going to be extrapolating and saying, okay, maybe your yield reductions are overblown. Maybe the disease pressure is overblown. I'm not sure what to make. As we came into this today, I said these numbers leave me with more questions than answers. I can't wait to see what Karen has to say. But technically speaking, like if I just look at this on its face, technically speaking, we'll probably have to, you would not be surprised to see a test of 410. If we hold there and get back up toward 420 something, then okay. But if we don't hold,
certainly, and that's really what comes down to, right? Is how does the market react to this new news and this new change? It's a higher, yet adding more to that supply side that a month ago we were a lot more worried about. But as like you mentioned, that disease has crept up through Iowa and Illinois. Some of the estimates we have thrown around in our group, unofficial, there could be as much as 500 million bushels lost from Illinois and in Iowa alone there. It makes this 300 million we just found negligible. If anything, we're still 200 million short from where we were in our last estimates, if those production numbers come true here, right? So like it's you hate to say it, but like it brings up, and I'm going to put that conspiracy theory and tinfoil hat on. Is there pencil pushing going on, right, to make sure we add in those bushels somewhere else if they're going to be coming off later? I don't like to get into the games that like the USDA plays to, I don't want to say fit statistics, but generally speaking, there's a model that they follow, right? And they are very, 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 very proud of the fact that this August number doesn't change that much from their final. And so that August number doesn't. So there's other things that get played with here, and this could be one of them. And
again, I walk around in a foil sport coat. So I'm not the person to take you to task for that. And I bet you that there's a lot of folks out there that are thinking the same thing you're thinking. Right or wrong, you're not the only guy thinking that. Market
digests it, right? We're not saying it is one way or the other, but if we found 300 million bushels, right, just on the drop of a pin, in theory, that could be rounding errors. There could be standard deviation things in statistics that say, hey, is this relevant or not? And that's what Joe and I are just trying to get at.
I don't really want to talk about wheat, so we should probably do that. First sentence in Mark Soderberg's commentary today from ADM, nothing in today's USDA data likely to cause a speculative short covering rally. Whole world, it seems, waiting for some sort of input or impetus for a short covering rally there in Chicago wheat. And this ain't it, right?
Right. And I mean, you had a production number come in at 1.985 above trade expectations. So yeah, a crop's only getting bigger there. I mean, from what the last I saw, we were trading lower and hunting out lows on the day. I mean, I do think that when you start
new low,
I'm sorry,
new low,
yeah. I do have to point out that like I feel like everybody is getting bearish, right? All the talk, all the writing on wheat is negative, and when you get people saying, "Oh, there's no hope of a short covering rally," I think Mark does great work, but I also think that there's some truth to the fact that this market's oversold, getting overly bearish, right? Like at some point, wheat gets a short covering rally. We're not here to catch a falling knife and get ourselves chopped up in that capacity, but it is worth noting that the litmus test on wheat is pretty bearish right now.
This knife has been falling since June.
Yeah, exactly, right? Like
goodness gracious.
And as we point out on the chart all the time, at some point in time, it'll get that short covering rally to test the 200-day moving average, but it doesn't mean it's a major reversal, a low in the price for wheat for anything more than a short covering rally.
Big volume on today's new low move. Opened at 419 and a half. The high was 419 and 3/4. Low 406. I'm sorry, 519 and a half, 519 and 3/4. Low was 506. A little Freudian slip there. Low 506 and 3/4. Closed at 508, down 11 and a half on about 82,500 contracts of volume. One of the biggest days in volume in the last 6 or 7 or so, and probably one of the second biggest days in volume in the last month. So that's the technical picture in wheat. nothing below that I can note. Everything above moving averages were kind of coagulating a little bit there at 520, not anymore.
And to that point, right? Like everything's above you now. It's just everything. It's a downtrend until it's not. But at some point the buyer is going to be right. But it's just not today.
Not today.
Glad
we got that out of the way.
Right?
Got that out of the way. That was terrible.
Yeah, I mean, right, what can you do? You rip the Band-Aid off, sell wheat, live in a mansion. All right, soy is September 1st. Stock numbers coming in at 316 million bushels. That is slightly below the 323 pre-report trade estimates and lower than 2024-25 ending stocks of 330,000. September 1st, 2024, we're at 342 million. I don't know why I said 1,000 there, but so really, tighter soy number there, not terribly much, but unfortunately, USDA could print 0 on that stock number for soybeans. And until we see exports, none of it matters. And that's, I think, what the market is saying today, right? It was otherwise a slightly bullish against trade expectations, not very much, right, in the soy category. But when you take a dive down and start to consider the export market, that's where things falter a little bit here. And I think why we're still hovering on top of that $10 mark.
This market has really been under pressure since an attempt to get out over 1060 failed, then an attempt to stay out over 1050 failed. And we have kind of been under pressure as we have been loping into harvest here. And and the idea that the market is coming to terms with what we talk about seems like every day here at Zaner Ag Hedge. And the difference between what help me phrase this. What I'm really trying to say is the market is coming to the realization that as of yet, we have nothing on the books to send to China.
Right.
And we're running into a time period where if we don't have it on the books, we're not going to get it there. And they're doing great work sourcing beans from South America, most recently Argentina. And so I don't know. Here again, this is what leaves me with more questions than answers, is that if these guys continue to sell beans in Brazil and Argentina, will we then be exporting to them? And certainly there's no way to get to them the kind of volumes that we would have got to the Chinese. And that is, unfortunately, I think that is what this chart is telling you, $10. Hopefully that holds. There was some discussion prior to today's report. Dan, I don't know if you and I engaged in it, but certainly it wouldn't surprise me if we had. Is this priced in, right? I mean, are we aware, is the market aware now that we're not going to get these beans to China? And some discussion internally here at Zaner Ag Hedge that no, it is not priced in. So I'm not sure what to make of that.
Yeah, I don't think it's priced in, but I also think that it's fair to say that the price of U.S. beans on the global market are so cheap that there could be some trade wind counteracting that. If you want to make some money, buy U.S. beans and arbitrage them to where there's demand. Like that's a thing and can be a thing for people today. And that's what Joe was pointing out. Like if Argentina and Brazil sell out of their crop to China and China's still hungry, does Argentina and China and Brazil source from the United States for their own internal domestic demand? You sell your crop at a premium, buy the United States at a discount, and Argentinians can continue to crush, right, without any problem. And there's problems with the infrastructure to facilitate that, but it's absolutely the name of the game of how this has to and needs to go. And I would love to see, just on a side note, I'd love to see the U.S. working more with South America to set up more of a bilateral trade relationship for corn, wheat, and beans between the United States, Brazil, and South America. What if we had virtually open borders for being able to arbitrage between our nations as we see fit to combat Chinese demand as an oligarchy effectively? Let's start the soybeans OPEC. I don't know why we haven't done that yet, and maybe we will. But the idea is that if China, who is hand-to-mouth in their purchases, hasn't put purchases on our books by November and into the end of the year, you have that massive South American crop and purchasing that they can be doing and get on the books down there. And unfortunately, with a trade, and we remember this from the 2016 to 2018 era with Trump, trade war 1.0, they took the soybean sales and ag numbers in that deal all the way to the 11th hour. So if we are going to see soybean sales, I feel like it's going to be somewhat of a surprise into the tail end of this year or early next year as part of some kind of trade agreement. But until we see other trade news with China, soybeans are just sitting pretty, not doing anything, because I think there's a case to be made that there could still be some massive purchases of soybeans and still be some demand from China in the United States market, but we're running out of time. And you can see the chart almost, I think it's becoming palpable on that $10 figure of saying, hey, I don't deserve to be up here if we can't get those sales on the books.
One of the things that caught my eye today was a chart that Karen had generated regarding that 2018 trade episode where we had been trending higher 40, 50, 60, 70% plus of U.S. soybean exports to China. 2018, wham, that number drops to what I think was essentially near zero.
Yeah, basically zero.
Right.
Yeah.
And so, but then what caught my eye is how fast it bounced back into the 60% plus, 70% plus, which to me furthers the argument that you don't hear often about the quality of U.S. soybeans and the storability of U.S. soybeans and the quality of the U.S. distribution channel. And I know a lot of end users like to say, oh, beans are beans, but that's not the case, right? American beans are better. They're more storable. You've got better distribution channel, in my opinion. If this wasn't as politicized as it is, I think that your end users would prefer to get beans from the United States. And that may be what that chart tells you.
Yeah, if Argentina relies on crushing, wouldn't they rather sell their crop, which would not yield better crushing capacities than ours, and buy ours at the cheap? I mean, it makes sense for that naturally to occur. So yeah, and the end user in China would feel the same way, right? They want a better byproduct. So I see no reason why there isn't that utility of demand. The problem is we have to get the politics and the deals out of the way that can actually make it allow it to happen.
For sure. Hopefully that happens fast.
Yeah, absolutely. And I think the only other thing to really point out here is how far off, remember, that stock number was in terms of trade analyst expectations to where the corn is. So that alone tells you that it's the questionability of whether or not this market's pricing it in or not. So if we don't see that follow through on corn into tomorrow on the back of this bit of a surprising news, I'd say there's some support on that market to try to pay attention to. But I also think we're at the 11th hour here, and both corn and soybeans are teetering on potentially the edge of that cliff. And I'd hate to see things become a Wile E. Coyote here and start to drop. So keep that in mind, everybody. And before things get too late, use this opportunity to get some sales done or protection done, because, hey, we didn't get the rally we really hope for off of a quarterly grain stocks number right now. Market looks like it wants to hunt out and find potential lows is kind of the feeling. Does it need to price in this lack of demand we're seeing in soybeans and now larger production or stockpiles potentially from corn, right? That's what was weighing on this market right now into harvest. So we're cautiously optimistic that we could hold the supportive levels we are, because, hey, things haven't broken down massively, but we all know that they spent so far and so long in these ranges, it's only a matter of time before we test down into 9s or back up to 11s for beans, sub 4 for corn, or back up to $4.50, $5.
I know you do a great job in pointing out
here anymore and much longer, right?
I know you do a great job in pointing out how the markets look via the spreads and the carry that is built into some of these further out markets. Mm-hmm. Can you comment about that? Where it looks to me like we see significant carry. And so even for guys who are forced to sell now, right? You've got cash, you've got obligations, you're going to have to sell. These are not going to be the best possible prices. You can either store and take advantage of that carry. Not that I'm recommending that. Everybody's situation is different. We have to look at it individually. But if you are forced to sell, you can take advantage of higher prices later by simply putting up some of these call spreads and taking advantage of the ease of use of those options. Am I right? Two things right. I'm asking about there. One, make sure I'm right about the carry, and two, confirm that what I'm looking at call spread wise.
I don't think we're going to have a market that is going to be wildly inverted in the first quarter of the year like we did last year. Last year, it was like the market was dying for carry to be built in. This year, there's already some carry being built in. In other words, spreads are at or under, they have carry out into the future already starting to be built in, which is a undertone of a well-supplied market, right? That is going to need to store some of this capacity because it's not going to get gobbled up by the current demand. So we see bases that are not necessarily inducive to wanting to haul it into town today. We see storage for prices that are very high because there's competition now for storage at a time where we're going to have a big crop and low prices. People who can will store it, right? So storage is going to be at capacity. You've got high interest rates. So those that don't own their own storage are going to be paying additional costs and fees for that carry charge into the future. And last but not least, the spread market, the only place you can try to capture some of that, still has some of that carry that you can capture. In other words, we haven't gone to full carry. The carry between now and May, for example, isn't down at 60 cents under where it could be. It's hovering around. I'm just spitballing probably around 10 or 20 cents. So there's still room to build in and carry to be attracted into this market. And I do believe that is the type of fundamental market we're moving into, a well-supplied market that doesn't have much demand shock going on, which means it's going to seek to try to storage, and the market's going to have to incentivize that storage by building and carry into those spreads.
Also, you have the possibility of weather. So far,
right.
South American weather near ideal, right? But that's
right.
not always,
and I think
things change fast.
And when you're considering the U.S. market, we're not going to have a weather shock until May at the very earliest for a late plant. So between now and that March to May timeframe, you can see that kind of basically bear market set up in the spreads. It doesn't necessarily mean it's going to happen to the outrights, but the spreads will very likely try to build in some carry while they can here before we have any need to build in premium or take it out of the market, right?
So if you're going to be forced to sell, do you put up call spreads here?
Yeah, I think you would want to put up some call spreads. Timing of that, you can afford, I think, to even wait on that, right? Where we're at. Hey, reownership strategies before we get out over 1050 and 450, you might be sitting and idling for a while here or catching a falling knife. But I do think if you're forced to sell, there are some lock type levels that if we start to go back above, you don't hesitate to buy. And if you want the confidence of having that reownership on, a call spread gives you the advantage of less risk outright, plus that short call that if the market does go down against you, you can utilize by working with a broker like Joe or I to help manage that call and call spread into the future. In other words, you're kind of hedging your long call in a bit with that short one, helping the market pay for it. So it gives you some exposure to the downside if we're wrong in the here and now, and can readjust the position for when a harvest low finally comes into place to really capture the upside when it finally begins.
Best of both worlds. You can
exactly
experience some savings on the actual spread and then trade out of the short side and open the upside back up.
And you can, at this point, then you can only lose in the futures account what you spent on that call spread, which is really the magic of risk management at the end of the day.
Beautiful thing. Yep. Absolutely.
Well, thanks for listening to the Zaner MarketCast today. If you need more, just because you can't get enough of us, you can follow us on Facebook at Zaner Ag Hedge or on Twitter and LinkedIn at the Zaner Group. If you have a question you'd like answered on the show, there's a link for you to do in the description of that. Just follow the instructions and we'll answer it right here on for you. Thank you again, and be sure to like, comment, and follow the podcast to not miss a beat. And we'll be back with you as price action develops. Take care, everyone.
Have a great week, everybody.